Welcome to today's lecture, and today we'll start and maybe complete talking about risk management. We've seen at several points in the lecture that banks deal with risks, and banks can even be seen as risk managers, as financial intermediaries that are concerned with managing risk on its own books, but also concerned with managing risks of investors and depositors. And for several reasons, risk management is one of the main functions within a bank. And banks are one of the few industries where risk management has always been done, even centuries ago, whereas in some other industries, like for example energy and utilities management in some industrial sectors, risk management has only recently been included in these industries due to the rising complexity of the respective business. But risk management in banks has a long history and a long tradition, just like in insurance. And you've might have seen that we also have a lecture and a module on financial risk management in the summer term. And here I will only present to you the basic concepts of risk management, risk measurement, and one could spend hours and hours talking about risk management from a more qualitative standpoint, but also in quantitative risk management. I usually start with a basic notion of what is risk and what risk management is all about. Risk, it's even a philosophical question. How would you define risk? Any ideas? You could even go down into detail and say, okay, risk is everything that is undesirable and is not desired by an investor. If it's undesirable and it's might be that an undesirable event happens, well, this is risk. This is a risk for the investor. And in this part of the lecture, and also in financial risk management, we usually concentrate on financial losses that are perceived as risk by an investor. More precisely, it's uncertainty about the occurrence of possible states of nature. Environmental conditions is a rather unfortunate translation, rather states of nature. And as a result, uncertainty of achieving certain outcomes and specific business goals. Now, usually you as an investor or as a firm, as a company, you have a certain aim, you have a certain goal you want to achieve. And if a situation arises in which you are not certain that this goal can be achieved, it's a situation under risk. If you go to risk theory, actually, this is quite the exact definition of what is risk. Has anyone ever heard a lecture on risk and decision theory? In German, Entscheidungs- und Risikotheorie. Okay. There are several distinct situations you can find yourself in. First, if, for example, you know what happens and what the future will bring, this is a situation under certainty. You know all the possible outcomes and you know what will happen. Then it's a situation and a decision under certainty. Next possible state is that you do not know anything about the future. You do not know what could happen, what outcomes are possible, and especially you don't know any additional information, for example, probabilities. Then it's a classical situation under uncertainty. If you at least know what could happen, and if you can assign probabilities to these potential outcomes, then it's risk. It's a situation under risk and a decision under risk. This is the distinction made in decision theory and risk theory. In German we call it Entscheidung unter Sicherheit, Entscheidung unter Unsicherheit im engeren Sinne und im weiteren Sinne. Und this situation where you know the probabilities and all potential outcomes, this is a situation and decision under risk. And this is what we assume here. We are not completely blank. We at least know what potential outcomes there are, and we can assign probabilities to these outcomes. A simple, easy example of such a decision and a situation under risk, where in a situation in which you do not know what outcome will happen, but you at least know what potential outcomes there are, and you know the probabilities. If you throw a dice, you know there will be a 1, 2, 3, 4, 5, or 6 on the dice, or on the die. I think it's a die, the singular is die. And you know the probability is 1/6. It's 1/6 probability. Now, as we are concerned with investments and loans and other assets, we concentrate on financial losses. And financial losses are perceived as risk. So any deviation from a given parameter, from a planned outcome, and from an expected target value, if you like, this is risk. And these are potential losses we might, as a firm, occur as a bank. And in this class, you see, we take random negative deviations of financial variables. For example, the net value of an asset, of an investment, or the net value of a loan. That might be the random variable. And if we have random negative deviations of what we would expect, we would call these later on losses, potential losses. And this is what we try to model in risk management. I make this distinction here, and it's important to stress this distinction, because in some other areas of financial mathematics, you do not take random negative deviations, but for example, in insurance mathematics, it's all about positive random variables. In insurance mathematics, there are only two outcomes, more or less. First outcome is you, as an insurer, do not incur a loss, everything is safe, and you do not have to pay out anything. So you have a 0. And the second possible outcome is that you incur a loss, an insurance loss. For example, a storm destroys a house, and the insurance client claims a loss, and then you have to pay out something. So the claims are usually either 0 or, for example, 100 euros, 200 euros, 1,000 euros, and so on. And you do not need to use negative numbers, because it only makes calculations more difficult. So you concentrate on positive numbers, and a positive number is a loss to the insurance company. And all of insurance mathematics is actually a theory of positive random numbers. Here, we are looking at the changes in the value of an asset. So in fact, it could go up 100 euros, it could stay at 0, or it could decrease by 200. So we use random variables, and we only consider these negative numbers a loss. Okay. Different characterizations of risks. First of all, and characteristics. First of all, it should be random. If you know beforehand what will happen, this is nothing that needs to be done and needs to be handled within risk management, but this is simply a loss you have already incurred. It's the same when you think of accounting. If you know that you need to pay out a certain amount of money, you do not need to manage it, you only need to pay out the money. And you have to account for it on your balance sheet and income statement, and you cannot change the outcome. But here it's all about the fact that these losses are random. They might happen, but you can still prevent them from happening. It usually are negative deviations. So if we think of, for example, changes in the stock price of an asset, might be plus 1%, plus 2.5%, or minus 3%, and we concentrate on these negative losses. I'll talk a little bit more about this later on, but usually we concentrate on the negative losses, and we do not do a change management, or chance management, not change management. We do not do a chance management. And Next, we only consider financial risks. Why? Because risk management is also sometimes thought of as encompassing reputational risks and other non-monetary risks a firm could incur. For example, if we lose all our customers, if we have a big scandal, our reputation suffers, and one could think of as this being a reputation risk. Yes, it's a risk, but usually the firm cannot really do much about it. It can put in place proper governance to prevent such scandals, but it cannot hedge against these scandals. It cannot measure these scandals because these are just random events that might occur. And ideally, these risks should be measurable. You should be able to put a number to these risks and, of course, a monetary number. It's quite simple. If you have a financial investment in a stock, you know that if a stock decreases by 3%, you've invested 1,000 euros in this stock, you know, okay, this amounts to minus 300. So this is the loss potential. No, 30. Yeah. Here's a mathematician at work. So these are the characteristics of the risk we want to deal with. I've given you a couple of examples on these slides concerning the discussion whether only negative deviations, financial losses, should be dealt with within risk management. I would say yes, but of course, every day risk management is concerned with potential financial losses. You lose money on a loan, you lose money on an investment, in a stock, in a bond, etc. But there are a couple of counterexamples that show you that risk management should not only concentrate on potential financial losses. The first example is Barings Bank. Barings Bank used to be an old, large investment bank in the UK. You probably don't remember it because it went bankrupt in 1995. Quite an interesting story there. It went bankrupt overnight because of one rogue trader, Nick Leeson. Not Liam Neeson, but Nick Leeson. And the thing he did is he traded in derivatives, and he was, I think, the chief trader in the Singapore office of Barings Bank. And he did the usual thing rogue traders do. They keep two accounts. One account for the profits and one account for the losses. He hid the account where he hid the losses, and he only showed the profits on his second account, and subsequently he was promoted every now and then because he was raking in such large profits for the bank. And afterwards, I think he was a chief derivatives trader in Singapore, and he was engaging in spectacular trades and large risk-taking, and he was able to hide all the losses from his highly risky transactions. At one point, and this is also what usually happens, we saw this the last time during the financial crisis, if there is an exogenous shock, these rogue traders are no longer able to hide their losses. And in this case, in 1995, it was the big, what's the name? The big Hanshin Earthquake in Kobe and Osaka. Probably you don't remember that, or you weren't born, that might even be. In 1995, large earthquake hit the region of Kobe in Japan. And the earthquake, I think there were a couple of thousand fatalities, and there were extreme scenes in Kobe. For example, the motorway flipped over, and some buildings, people then realized that buildings, and especially highway and motorways, were not built to the highest standards, and they flipped over, and there were large fires in Kobe, and it was a real big tragedy in 1995. And because of this, all the stock markets in Asia plummeted, and the losses on the positions of this rogue trader were so immensely high that he was no longer able to hide his losses. What did he do? He packed his bags and fled. And he was arrested at Frankfurt Airport and extradited to the UK. And he spent a couple of years in jail. And I think he's still alive. I think he had cancer in jail, was released from jail, and is now writing books on rogue traders. Now the question is, what does this example tell us? It's one example where in which superiors should have realized that such exorbitant profits are not able, and people are not able to generate such profits without risk taking. And if they had realized the simple idea that no risk, no fun, and you need to take on risks to generate such high profits, they should have realized that he was not the phenomenal trader they thought he was, but he was just simply defrauding the company. And this was all due to illegal activity. So extremely high profits also tell you something about the risk the company is taking. And some warning lights should have gone off here, and the superiors should have questioned his abilities rather than promoting him through the ranks. Okay. The second, yeah.
How can you hide a second account from the accounting section in the first place? They don't realize that there's an account with millions.
The larger the bank, the larger the bank is, and the more eager you are to act illegally, the more creative you become, and the processes at these banks may be, in this case, Barings Bank, Société Générale had the same problems in the financial crisis. There are always possibilities to do this. Unfortunately, yes. And this, again, also shows that a bank should have proper risk management in place to detect these cases. It's not the problem that these cases from time to time occur, but firms and banks should be able to detect these cases before they blow the whole bank to pieces. And this is actually what happens with Barings Bank. It went bankrupt and it ceased to exist overnight. It was a large scandal. So this was, and a loss of, as you can see, $1.4 billion. So that's during a time in which this was not the financial crisis. So there was a singular event with horrendous losses. Second example, Bernie Madoff. He was the operator of the largest illegal pyramid scheme. This is a nice way to describe it. It's a Ponzi scheme. In English, it's called a Ponzi scheme. In German, it's Schneeballsystem. Do you know what a Ponzi scheme is? It's called Ponzi, P-O-N-Z-I, because of the person who first did it in the US back in, I think, in the 19th century. His surname was Ponzi. How does a Ponzi scheme work?
You say you have an investment opportunity that has huge benefits or can generate huge returns, and you get some people to invest in it. And some of them get paid out by the investments of others. And they get new investors, and then you pay them out again from the some part from the investment.
And it goes on and on and on. That's the basic idea behind any Ponzi scheme. You take investor funds, you promise a constant high return on these investments. You don't do anything with this money, you don't invest it, but you pay out this high return. And this attracts additional investors. And this is where the Ponzi scheme starts. You rake in more money and you pay out the new investors with these additional funds. And it only works as long as you are able to generate more money, more investments, and more investors. Again, here, the exogenous event that caused this whole Ponzi scheme to collapse was the financial crisis. During the financial crisis, all investors suddenly needed their money. They wanted to get out of this fund. And as he did not invest the money, he wasn't able to pay back any of it. And it amounted to a loss of approximately 65 billion US dollars. $65 billion. And the statement of a whistleblower is quite interesting here. The statement reads, but the biggest tip-off of a fraud was that Madoff reported his fund was down only 3 months out of 87, whereas the S&P 500 was down 28 months during the same period. So he was able to beat the S&P 500 in at least 25 months out of 87. And probably even the rest. So this is just not possible. And this is something you could see during the whole financial crisis. You remember the case of the Qualitative Bank in Germany, as an Icelandic bank that also operated in Germany, and they offered derivative certificates to investors, and investors thought they actually had a deposit account. And when Qualitative Bank went bankrupt, they thought their money was safe and secured by deposit insurance, but later on they realized, no, this is actually not a bank account and not a savings account. And again, the same situation there. I mean, they also, they were given false impressions by the bank, but again, if you are guaranteed a constant return of, say, 6, 7, 8% in a period in which all other investments only pay out 1 or 2%, you should get suspicious. You should not believe that this is a risk-free investment. Same here. Biggest tip-off was that he reported his fund to generate exorbitant profits and returns in a time where even the S&P 500 was not able to generate a high return. So the bottom line here is we concentrate on financial losses, but it's also quite instructive sometimes to look at the profits and the outliers when it comes to profits. And some profits are just too good to be true, and then risk management should step in. Okay. Now, how do we measure financial risks? I've given you here a plot from DataStream, and this is the S&P 500, the composite index. As you can see, we have the German data here, but you can see the time evolution of the S&P 500 from 95 to 2015. And now, what is risk? How should we measure risk? There are numerous ways to measure risk. One way would be to look at the time periods and the points in time at which the S&P 500 was down. You could calculate returns, you could calculate log returns, you could calculate the extreme log returns, and so on. And there are several ways to measure risk, and we'll look at each of these possibilities later on. A quite simple way of measuring risk would be to take the VIX, the volatility index for the S&P 500, and here you can see, well, it's more or less the same. You can see that during the times in which you had a high volatility in the S&P 500, this index has large spikes upwards, and large upward spikes, and there is a period of time here around 2003 and 2007 where it actually had a stable increase and volatility was quite low. But afterwards this year, because it's a financial crisis, and you can see here volatility spiked. So you could use the VIX index, the volatility index for the S&P 500. And I've downloaded this data, and what I show you on these slides are just some simple calculations you can do with the S&P 500 price index. Now this is the price index. Okay, you know what the S&P 500 was. These are the S&P 500 log returns, the corresponding log returns that correspond to the price values I've shown on the slide before. So these are log returns. Okay. Does anyone know why we usually concentrate on log returns and not discrete returns? There's a major advantage, or there are several major advantages to using log returns, continuously compounded returns. In German, it becomes quite clear. In German, we call it diskrete Renditen and stetige Renditen. If you take log returns, the random variable that describes these log returns is a continuous random variable, in contrast to a discrete one. And it makes calculations more easy and quantitative modeling more easy and easier. Yeah?
Is it only locked or is it also derived?
What?
Is it only locked or is it also derived? Like the first.
What do you mean with derived? This is the natural logarithm of price pt minus the natural logarithm of pt minus 1. So the difference
that's right.
log prices. Yeah, exactly. Mm-hmm. Okay. You could take the absolute returns. When you take the absolute returns, you get a better impression of the volatility. It's not exactly a proper measurement of volatility, but you can see again the financial crisis, the dot-com crisis and dot-com bubble around 2000, 2001. And you could take absolute returns. It's one way to look at it. You can take the volatility. I have to admit that the volatility here is simply calculated with the use of a rolling window. It's not a sophisticated way of modeling the volatility, but for our purpose here, for illustration, it suffices to use a rolling window. And you could also take the log returns that are below the 5% quantile. And you can see here that these were the days probably at Lehman Brothers where the S&P 500 took a turn to the worst and took a hit of almost 9–10% daily returns. So there was a 10% decrease in just one day. You can take the log returns below the 10% quantile. And this also tells you something about, and you can take the 90% quantile or the 95% quantile. And all these are different ways of looking at the data. Okay. We'll talk about risk measurement in a bit, but it suffices to say that there are numerous ways of looking at data, looking at different ways of measuring risk, and we will learn about a couple of risk measures later on. But now let's focus on a definition of what risk management is. Now, management usually is the process of analyzing a business problem, coming up with a plan, going through with the plan, controlling and checking the efficiency of your plan, and taking actions if you have not reached your goal, and document everything that you've done. This is the usual cycle, the business and management cycle you have, and this is true for marketing management, change management, business process management, etc. In risk management, it means that you measure risks. You identify, first of all, you have to identify the risks. You measure them. You take actions against them. And later on, you try to measure the efficiency and the success of your risk management. Now, then risk management is simply the sum of all measures for the specific identification, measurement, management, and the controlling of risk in an enterprise and all other factors that might influence the enterprise in the firm. And if you think of the basic aim and primary goal of risk management, what should it be? It should always be the maximization or at least stabilization of shareholder value. You can argue a lot that risk management should decrease default risk. It should decrease financial losses. But in the end, it's all about shareholder value. It's not about stakeholders. It's about shareholder value. Of course, stakeholders like the government and regulatory bodies also have an interest in proper risk management in a bank. But from a corporate standpoint, for the bank itself, the primary goal is increasing, maximizing shareholder value. Now, this is quite interesting, actually, shareholder value, because theoretically, risk management should not matter. There are important research articles and research results dating back to the 80s and 90s that use the Modigliani-Miller theorem of capital structure, and they apply it to the problem of risk management. And they show that actually risk management yields the same situation and the same result as capital structure within a Modigliani-Miller framework. That is, risk management should not matter for shareholder value. The idea is, just like with capital structure, if you take an investor and you have a perfect capital market, the investor, he or she will not care about the capital structure of a company. If he wants a certain mixture of debt and equity, he can simply buy up shares of this company fully financed with equity or this company fully financed with debt. So capital structure, in a very simplistic way, doesn't matter. And here it's the same. If you want to have a certain risk-return profile, you simply buy stocks and buy shares in companies that have a certain risk profile, and risk measurement and risk management should not matter. But as soon as you introduce financial frictions, transaction costs, taxes, the costs of financial distress, and other financial frictions, risk management becomes useful and should increase shareholder value. So a similar situation like in the Modigliani-Miller framework, within a capital market that is perfect, firms should not engage in risk management, but for reasons of financial frictions, they actually do. And there are some empirical results that analyze which financial frictions lead firms and especially banks to engage in risk management. Yeah.
But the risk profile of a company is strongly influenced by its risk management.
Yeah, but if the company wishes to do so and investors want a different risk profile, you can simply, again, if you have two companies and this one, let's make it very simple. A does risk management and B doesn't. And you as an investor want a certain risk return profile. Instead of investing in the risk management or the bank with risk management, you can simply divide your investment onto company A and company B and create your own portfolio of shares that has this certain risk return profile. The same as with capital structure. If you have no transaction costs, without taxes, etc., there is no advantage to debt. And if you want an investment in a company that has a certain capital structure, you are indifferent between choosing the company with the right capital structure or simply buying shares and bonds in this company and another company with different capital structures. So capital structure is irrelevant. And it's the same here. You simply combine the shares in a company with different risk return profiles, and risk management doesn't create value. I can give you a simple example, for example, why taxation as a financial friction immediately creates a bonus and a benefit to risk management. Assume that you have two outcomes, let's say A and B. Now you have this and this potential profit. Now you have risk. Why? Because there are two possible outcomes. One low profit and one high profit. A is a low profit, might also be a loss, and B is a higher profit. Now, your expected profit is on the direct line between A and B. And what will happen if you, for example, say, okay, C is the situation with risk management. You simply have two outcomes and you hedge. You hedge your outcomes and you end up in point C. Now what will happen is that if you have A and B, you pay A bar and B bar as taxes. So here you have taxes and here you have profits. Or you don't pay taxes at all. And what will now happen if you have a linear tax function or no tax function at all, you will pay C bar. And this is the same as your expected return. But tax rates are usually not linear, but convex. That is, just like, for example, with income tax, if you have a low income, you pay 10%. If you have a high income, you pay 40%. So the tax function actually looks like this. And then what will happen if you don't do risk management? You might pay A, you might get B, and in expectation, you pay this in taxes. But if you hedge, you will get C for sure, and you will only pay this in taxes. And the difference between these 2 points, this is the tax advantage of risk management. A simple idea, and actually it's the same idea, for example, with our German tax, German income tax. If you have a married couple with a high and a low income, our tax system allows you to tax the average 2 times. We call it in German, it's Ehegattensplitting. The very same idea. You have one high and one low profit or income, and you average it, and then you have a small tax bonus and a tax benefit because of the convex tax function. And here it's the same idea, just that you have 2 incomes and 2 profits that are random. So with financial frictions, tax management actually does make sense. By the way, empirically, taxation does not seem to be the reason why banks and firms engage in risk management. It's more executive compensation. It's more about executive compensation and costs of financial distress, but not taxation. Okay. So primary goal, maximization of shareholder value. Risk management, of course, represents a continuous process. It's not a static one. And since it's a central management task, you cannot delegate it to someone else, but it's something that needs to be done at the top level, and it cannot be outsourced to other companies. And this is, I think, quite clear. Okay. Now, this is risk management. So the systematic management of all risks a company is exposed to. It entails the measurement, the identification, measurement, and the management and hedging of these risks. And then let's have a look at this risk management process. We first need to identify the risks the company is exposed to. So which risks do we have? You can do the same here, actually. And some public institutions, like, for example, universities, are now also being forced to engage in risk management. For example, what risks are there? If you think of the university, if you think of this lecture, what potential risks are there? First of all, you need to think about what is your business you're in, giving lectures. So what potential risks are there? I always give this example. The first example is, okay, this might not happen today. If the beamer falls off, it hits a student, this is a risk. It's a litigation risk for the university, and the university needs to be sure that all its buildings are safe. We have fire detectors in place everywhere. We have emergency buttons. So this is all part of the university's risk management. You need to identify these risks. And in some cases, it's more easy if you buy a stock. It's quite easy to see that you have a market risk. If you give out a loan, you have credit risk. What I've just described to you, for example, beamer falling off the wall, fire breaking out, these are what we later will call operational risks. These are risks that are not financial in nature per se, but these arise due to the specific operations the company has. So we first need to know what risks do we have. Then we need to assess and measure these risks. For example, in case the beamer falls off, we need to know how likely is it that the beamer will fall off, how likely is a fire, and what potential damage could be done if a fire breaks out. Now, if the beamer falls off, probably there is a danger of severe health damage and severe injuries to a student. So again, you would know that in case you file a lawsuit against the university, probably you will be awarded in a German law, maybe 1 million, 2 million, and this is the maximum loss the university might incur. You will continue with the risk management. What can we do against this? In these cases, it's quite simple. There are several things you can do to manage risk. One thing is simply to buy insurance. Second thing would be to mitigate the risk, to decrease the probability that such a damage, such a loss can occur. First thing would be to send around people from the operations department to check whether all beamers and all fire detectors are in place, if they are operational, and if there are any difficulties with this. So this is a simple way of mitigating risks. You can buy insurance. You can try to hedge risks. And this is quite difficult for these operational risks. You cannot simply mitigate the risk by saying, for example, okay, I'll just put a different beamer in the class somewhere else. For a share investment, it's quite easy. What could you do to hedge against the market risk stemming from a stock investment? What could you do? Mm-hmm. Yeah. If you are long in a stock, you could simply go short with a derivative. For many financial assets, you can buy or sell financial derivatives, and the main purpose of derivatives is hedging. And you simply, if you have a long or short position, you go the other way with a financial derivative. And this is hedging. And this, of course, only works for financial assets, and it will not be able to do a proper hedge for the risk of the beamer falling onto your head. So this is nothing you can really do. One thing you can always do is to bear the risk. And why is it always to bear the risk? And why is it sensible to bear some risk? Because the bank engages in risk to generate profits. If all of the bank's business were risk-free, there would be no profits above the risk-free rate. But banks want to generate returns that are higher than the risk-free rate. So as a result, the bank will bear some risks, and as you can imagine, operational risks are different. And this is why we will talk about market risk and credit risk in more detail and leave operational risk a little bit out, because operational risk, you always want to prevent these risks. There is no upside to the beamer falling down. There is no upside to a fire breaking out in a lecture hall. But if you buy a stock and the stock decreases in value, this might simply be the risk you're willing to take in order for the stock to go up again. Okay. Then, after managing the risk, you need to do risk controlling. You need to check whether your measures you've taken have been effective and how these risks have been handled. And you have to communicate the way you have handled these risks, first to investors and creditors, and second to regulators. Because regulators, especially in banking, also in insurance, they want to be informed of what you have been doing with the risks. Okay. Some more information on each of these steps. Risk identification. First step, identify all possible risks. You have to distinguish between external and internal risks. For some risks, they arise within the company and they are endogenous. For example, if your own employees do something illegally, this is an internal risk. If your own computer programs fail, for example, if you have server breakdown and all of your employees cannot work, this is an internal risk. Some of the risks are external, for example, changes in market prices, exchange rates. There are also some external operational risks. Can you name some? Or can you come up with an example of an external operational risk? A risk that is concerned with, well, if I give you the exact definition of operational risk, you know what I mean. Yeah?
Bank robbery?
Bank robbery, actually, yes. Quite infrequent, but yes.
Some regulations put in place by the government?
Actually, that's not usually what we think of as a regulatory, no, operational risk. But unfortunately, there is now the there's now the new type of regulatory risk. Many companies now complain that they face regulatory risk. That is the risk that regulations change or become tougher. Yes. Operational risk is usually defined as the risk of external factors like natural disasters, catastrophes, and the failure of IT systems, internal processes, and inadequate behavior of employees. For example, if someone steals from you, that is an operational risk. If you have a flood that hits your company, it's an operational risk. But also a storm, an earthquake, fire, these are operational risks. In the financial risk management class, I always give this example. There are some, this might sound quite far-fetched, but I know of one insurance company, and all of these companies have risk management policies in place. I know of one particular insurance company that is located in Münster. The headquarters are in Münster, in North Rhine-Westphalia. And this insurance company has a policy and an emergency plan in place in case a nearby chemical plant explodes or something goes wrong at this chemical plant. The chemical plant is actually run by BASF, one of the largest German chemical companies. And if they have a problem, it might happen that a poisonous cloud makes its ways to the headquarters of this insurance company, and they have an emergency plan in place what to do if they have to close down the headquarters because of the chemical plant that is 2 kilometers away. Because in that case, you need to move all the employees out of the building quite quickly, and it might also be that you are not able to move back in all the employees within the next weeks. So you need emergency workstations, you need the IT to run autonomously, and you need a place where you can put all the employees and how they can continue working because your business does not stop. And in case this happens, this is, again, this is not a problem the insurance company can do anything much about it. It cannot sue the chemical plant. It's not the fault of the chemical plant if the insurance company is not able to operate in its headquarters, because this is, well, it's what we in German we call höhere Macht. This is a natural disaster, and you cannot sue someone because of a natural disaster, for example. But they need to keep their business running, so they have an emergency plan for this operational risk in place. In some cases, you do know what risks there are, but one should always be so humble as to know that you cannot identify all the risks. Best case and best example, Fukushima. Now, the Japanese have known about earthquakes for decades and thousands of years, and they know that earthquakes will happen every now and then, and they build their nuclear energy plants to such specifics that they are bomb-proof. Unfortunately, Fukushima was not built to withstand a tsunami. And they didn't think of the earthquake in the ocean causing a tsunami, causing the plant to experience problems. So, again, you might identify some of the risks, but the nature of risk is that there is at least something you don't know. And in some cases, it's the very nature of the risk. In this case, a tsunami. So, just one has to keep in mind to be humble, to know that some risk will not be able to identify. The question is, what can you do about it? Well, quite simple. As I've said, you have to bear some risks. And one way to deal with these extraordinary and unidentified risks is to hold capital. You hold enough capital, you hold enough equity on your balance sheet so that you are able to bear these losses. And these losses will not put you into bankruptcy immediately. Next step is risk assessment. Usually via methods of quantitative risk management. These methods rely on statistical, financial, and actuarial analyses, and you try to put a pecuniary number to these risks. For example, if I know I have an investment of 2,000 euros in a stock, I know that it's likely that I could lose 100 or 200 euros, and the worst case is I lose everything, so in that case 2,000 euros. I also have qualitative risk management procedures. These are used particularly for risks that occur rarely or are quite difficult to measure. For example, what is the risk of a tsunami? What is the risk that this university will be flooded? It might be possible via a freak accident of nature, but this is will occur quite rarely, and we cannot measure it. Same with nuclear power plants. If it blows up, it will cost a lot of money, and there is no sensible way to calculate the average costs of a nuclear power plant disaster. You just know that when it happens, you will go bankrupt anyway. So what you can do is you can do qualitative risk management, and you use methods from qualitative risk management to identify these risks within your company and to get more information on these risks. For example, just like I did right now, I could ask you, what risk can you think of? You do an expert interview or a feedback round, and you get impressions and ideas from your employees of what potential risks there are. For example, if I think of this, you could probably think of a fire. We're on the first floor, so flooding is out of the question. Power shortage, blackout, might be. So you can do a brainstorming and you can think of some potential risks. And then you don't need to measure it. I don't need to put a number to the potential losses that are connected with the fire. I can simply say, okay, there is the danger of a fire. I do not need to know whether a fire could cost me 1 or 2 or 50 million euros. I simply buy an insurance. In some other cases, it makes more sense because you need to do a cost and profit analysis and cost-benefit analysis to assess the question and answer the question whether insurance is beneficiary. But for some risks, you just want to prevent them at all. Okay. Risk management. What can you do to manage risk? You can try to completely avoid them. Just like I said, if, for example, you are not forced to buy a stock, you can simply avoid the whole deal and do not engage in a loan contract. You are not forced to buy a stock, and you completely avoid this risk. You can try to reduce the risk, for example, by doing a hedge or by diversifying your investments. You can transfer the risk, for example, by buying insurance. There's the slight difference between risk mitigation and risk reduction on the one hand, and risk transfer on the other hand. Risk transfer means that someone else will bear the risk. Risk reduction means you are able to reduce the risk. And mitigation is, for example, to set up limits. If we think of these rogue traders, if there had been risk limits in place, these rogue traders would not have been able to put up positions that were so risky in the end. Yeah?
What is a hedge?
A hedge. What is a hedge? A hedge position. Can someone explain a hedge?
So you protect your position in a certain contract or so you have made up by adding an additional contract and buying some financial derivatives or so to be sure that if in the first contract a loss occurs, then you, in the end, you don't have a real loss because you're still, the other contract will make this loss disappear from the profit.
Yeah, a hedge could, I guess, best be explained and best be defined by a contract or a financial position that is only done and only concluded in order to reduce the risk of a different position. Take, for example, you have an investment in financial asset A. Could be a stock, could be a bond. You buy a stock and you want to reduce the risk of this position. You engage in a different contract, you buy a second financial asset, and the risk of A plus B is smaller, hopefully, than the risk of A. No? So this is a hedge. You try to reduce your risk by engaging in a different financial contract. Now, within risk controlling, you try to review all the methods and all the measures you've taken to reduce risk. If you see that some measures have worked, you keep them. If some have not worked, you have to change your risk management, and you have to improve these measurement methods and control instruments. And it must always be checked whether the benefits of the measures taken justify the costs. For example, there's no benefit in engaging excessively in derivatives. If you have financial assets and you simply start buying and selling financial derivatives with no plan, this is not a sensible risk management. Yeah, you had a question.
The goal of hedging, isn't it to reduce uncertainty to the maximum amount you can?
Yes, to reduce risk.
To minimize it?
Yeah.
So that you can be absolutely secure about the outcome in the end.
That is a full hedge.
Yeah.
So if you are able to completely reduce risk to zero, it's called a full hedge. In other cases, you simply reduce it by a certain amount, and that you have a partial hedge. Last but not least, you need to notify your management and the stakeholders, supervisory board, supervisory authorities, auditors, actuaries, etc., of the measures taken within your risk management and of the success you've had managing the risk. Okay. So this is the risk management process. You start by measuring risk. It's in German. You continue managing risk. Then you have a feedback loop and risk controlling and communication. And then you again go back to risk identification. But you had a question.
No, I just want to say you skipped the previous slide.
It usually is a cycle. So if you usually start at first with a risk identification. Then in many cases, for example, if you come to a company, if you take a bank, they know what risk they have. They have market risk, they have credit risk, and they have the proper types, the usual typical types of operational risks. For example, a bank will always have will always have given out loans if it's a commercial bank, and it will always face an exposure to credit risk. So you do not really need to identify the credit risk. If you have a loan, you have credit risk. That's quite clear. Risk identification is more interesting when it comes to operational risks. Just like I said, you probably didn't think of my Beamer example. Yeah? And I could come up with different risks. I open the window, ferocious bird comes in, whatever. So this risk identification is not as important when it comes to market risks and credit risks, because it's quite clear. If you have a financial position in a stock, in a bond, if you have given out a loan, you simply know that you face risk exposure. Okay. So this is the risk management process. Now let's turn to the different risk types. Now, in analogy to neoclassical economic theory, one can differentiate between real economic risk and financial risk. We concentrate on financial risks. They can be defined as those risks that originate from the investment and financing activities of a company, and thus in the interaction with financial markets. In particular, these are risks arising from changes in market prices, defaults of debtors, and also from liquidity and illiquidity of financial assets. And these are the most important financial risks. I've shown you an extract from the 2013 risk report of Deutsche Bank in German, but you can see the general idea. They report in their annual report on the risk exposure they have, and you can see on the left-hand side in the first column that they show credit risk, market risk, operational risk, diversification effects, general business risks, and the needed economic capital. And then the next couple of columns, these simply show the business lines they are invested in: corporate banking, global transaction banking, private and business clients, and so on. Now, first thing you should note is that they distinguish between market risk, credit risk, operational risk, and then you have diversification and general business risk. First thing I want to point out is usually we are not concerned with general business risk. Why? General business risk is something you simply have to bear as an entrepreneur. If I set up a store right across the street and I try to sell sausages and no one is interested in my sausages or in my pizzas, this is the risk I have to bear if I enter the market. If I enter a free market and no clients and no customers are willing to buy my product, this is my risk. And no risk management will save me from going bankrupt if my product is not up to the standards of the market. You get my drift? If you produce a smartphone, if you are the producer of a car, if you're a car manufacturer, and you're not able to market your car and your products, this is a risk to you. This is a financial risk, but this is nothing that can be dealt with within risk management, because this is your entrepreneurial activity. Deutsche Bank has this included in its financial statement, but I have to admit that I don't really understand why. Usually risk reporting is all about market risk, credit risk, and operational risk. Next thing I want to point out is that for banking, this differentiation into three large groups of risk types is typical. Why? Back 10, 12 years ago, with the Basel II regulation in banking, Basel II introduced the notion that banks should report and should manage three types of risk: market, credit, and operational risk. And for the very first time, the Basel II regulation defined what operational risk is. Before that, banks did risk management for operational risk, but they didn't have a name for it. And Basel II defined more or less operational risk as the was more or less a bucket of risk that couldn't be fitted into market risk or credit risk. So this is why operational risk nowadays is IT risk, legal risk, and legal risks, risk of natural disasters, catastrophes, etc. Credit risk, market risk, operational risk. Okay. And the last thing I want to point out is that in the last line you can see the needed economic capital. What does it mean? Why is capital needed?
To make sure that you don't go bankrupt in case the risk is...
Yeah. The banks can engage in risk, that's their business, but they have to make sure, and regulators will require banks to keep as much capital necessary to cover all risk exposure and to cover all risks taken by the bank. This means that if you want to give out a new loan, you need capital. And this is a vastly important question in banking, because this means that if a bank wants to give out new loans, for example, it means that it will buy credit risk, it will invest in credit risk, and it will require capital to operate in this business. And right now, over the last couple of years, we've seen the tendency of central banks, especially the European Central Bank, to lower interest rates. Why? Because they want to spur investments by companies, by industrial firms, and they want to force banks to give out loans, because loans and lending will again spur investments by industrial firms and create employment. So this is the basic idea the European Central Bank now has, and has had for a couple of years. Decrease interest rates, make investments in industrial firms more attractive, give an incentive to banks to give out loans. Firms will pick up cheaper loans, will invest with this money and create employment, and employment, jobs, will spur economic growth, and economic growth benefits everyone. Problem is that if a bank gives out a new additional loan to, say, a firm, to an industrial company, the bank will require capital, and simply by decreasing interest rates and at the same time increasing capital requirements, because the regulators have thought and now think that after the financial crisis banks should be forced to keep more capital, increase capital requirements and lending, well, the effect hasn't been the one the European Central Bank and other central banks had hoped for. The effect is actually quite simple. Ceteris paribus, if you have a balance sheet of a bank and you see that suddenly banks, for example, have this in equity and this in debt, this means that they can do business as shown on the asset side of the balance sheet. If you now increase capital requirements, they can do two things. First of all, well, how can banks increase their capital ratios? There are two ways to do this. Yeah?
Shorten the balance.
Yeah. First idea is to decrease assets. In this case, the equity ratio will increase automatically, mechanically. Second possibility would be to
make use of cocoa bonds.
Use cocoa bonds also, but also easiest way, even easier than cocoa bonds.
Not giving up any more loans.
This is the first one. It can increase capital. If this is the balance sheet, it can increase capital, and then of course it can buy risk-free assets, for example, with the additional equity. Problem is what do you think banks did after increases in capital requirements, and still do? Every time a regulator increases capital requirements, they cut lending. Yeah, so the effect of higher capital ratios is usually a cut in lending, a credit crunch. And here you can see where this actually comes from. It comes from the basic fact that banks need to hold capital, economic capital, or regulatory capital, as we call it. They need to hold capital to cover risky assets on their asset side. Okay. Yeah?
If this form is so obvious to see, why is the central bank still proceeding with this strategy?
First of all, it's not so obvious to see because it's quite difficult to show this empirically. You will see a working. No. There is one publication coming out probably within this year in the Review of Financial Studies, I think, by colleagues from the IWH in Halle. They show this for the first time for European countries. And it's quite difficult to show this because capital requirement, it's an endogenous choice of the company, of the bank, and you do not know whether it's due to, if the bank cuts lending, you do not know whether it's the change in capital requirements or if it's something else that has also prompted the regulator to step up capital requirements. So regulators usually increase capital requirements shortly after or within a financial crisis. But if the bank now cuts lending, you do not know whether this cut in lending is caused by the crisis or by the change in regulation. And it's quite difficult to show this empirically. And the colleagues at IWH, they show this in a very fancy way. And there are few good studies on the effects of capital requirements. And the problem is that usually one can see that it's actually a credit crunch that is caused by this. And one would think of this because everyone in the European Union has been complaining for a couple of years now that the low interest rate policies of the European Central Bank has not led banks to to more lending. One could even be happy about this and say, okay, at least they have not engaged in excessive lending. But in some European countries, well, they might have. Yeah? Okay. So this is an example of an actual annual report where you can see these three types of risks. And we start by defining market price risk or market risk. And this is quite simple. Market price risk, it's even trivial. They arise as a result of changes in relevant market prices and can lead to losses as a consequence of unfavorable price evolutions. They occur whenever a good produced or required by a company is traded on a market or several markets, and the price of that subject is some repetitions here, and the price of the subject is that good is subject to fluctuations. And you can now think of all the different types of market prices. So give me a few examples for market prices. First example, stock prices. Next. Natural resources. Resource prices. Oil, gas, steel, pork bellies, whatever. Next.
Real estate prices.
Real estate prices. Real estate fund prices. What else? These are the natural examples. There are some that are not as easy. Next, exchange rates, the prices for foreign currencies. Foreign exchange risks are usually subsumed to be a part of market risks. And interest rates, the price of capital. So interest rate risk management is a part of market risk management because interest rates are nothing else than market prices for capital. So interest rates, sometimes also liquidity, but liquidity risk management is something that is connected to market prices but not really part of market price risk. Again, here you can see an extract from the 2013 risk report of Deutsche Bank. And they say market risk comes into existence due to the uncertainty about changes of market prices and quotes, including interest rates, stock prices, exchange rates, and resource prices. Correlations between these and their volatility. And you can have a look at this at home. It's simply an example from practice that even in a simple risk report from a bank, you can find these definitions of market price risk. And they also give it for their trading activities. Okay. Currency risks. Again, many companies, not just banks, if they have international business, they will face foreign exchange risk and currency risk. And this simply means that you buy or sell in a foreign currency. You might lose, for example, money if you buy in dollars or if you sell in Japanese yen. And there are some simple ways to decrease currency risk. What can you do? What is the easiest way to decrease your currency risks? And actually, this is done by most car manufacturers for several reasons, but currency risks are one of them.
On one hand, you could hedge as well the currency, and on the other hand, you could have, for example, as BMW, you could have a manufacturing plant in the US.
Yeah, that's the easiest way to mitigate this risk and to completely eliminate it. You simply put up a store or you build a factory within the country where you want to buy or sell this particular product. So this is one of the reasons, for example, all major German car manufacturers have plants in the US. They want to hedge against currency risks. They also have tax reasons and tariff reasons, but it's the simplest way to completely reduce currency risk. Simply produce in the country to which originally you wanted to export. Okay. Now, securities risk. Quite simple. If you buy a security, if you buy a stock, if you buy a bond, and you have a quoted market price for the security, the price could decrease, and in that case, you will face a loss. And it's quite simple to measure this loss. You simply take the difference in price, for example, the log return, and you get the change in your net value of your position. Of course, in this case, you are interested in forecasting the future losses and future volatility in this market price. And this is where statistics, quantitative analysis comes into play, and you want to use sophisticated quantitative models to forecast volatility. And for many securities, it's possible because of the richness of the data. For some stocks, you not only have daily data, but you also have high-frequency data, and you can try to model the volatility dynamics of these price and return time series. Interest rate risks. Interest rate risk, or more precisely, the risk of changes in interest rates, comprises losses on assets resulting from changes in the market interest rate relevant for an asset position. The basic prerequisite is that the value of an asset position, of an investment, is dependent on an interest rate. And examples of this are interest-bearing securities, loans granted, and securities whose value is determined by a net present value calculation. Now, every time you have a security or you have an investment whose value is dependent on an interest rate, you have interest rate risk. If these asset positions provide fixed interest payments, fluctuating market interest rates also lead to an indirect interest rate risk in form of opportunity cost. A simple example: I buy a bond, minus 100 units of currency, and I get 105. Second example: I have a floating rate note with a variable, and variable interest rate, and I get back the notional value and the variable interest rate. Two different situations, a fixed income and a variable income product. Question now is, in which case do I have interest rate risk? The first situation is what? I have a fixed income product, and do I have interest rate risk or not? Well, of course, yes, but why?
Because if the interest rate rises above 5%, you could get more money by investing in another asset.
Yeah, you have opportunity costs, and these opportunity costs will be reflected in the market price. Because what is the fair, arbitrage-free market price of this bond? You take all future payments and you discount them with the proper interest rates. So this yields a price, and at the time of issue, if you have paid 100 euros for this, and later on the market interest rate, which is included here, if this market rate changes, the market price of this bond will change. Then you will have interest rate risk. In the second scenario, it's even more obvious. If you have a variable interest payment on your floating rate note, your variable payments will immediately, directly change with the market interest rate. Again, you have interest rate risk. So it's a fallacy to think that simply because of the fact that you have a fixed income and a fixed income product, you do not have interest rate risk. You will always have interest rate risk because the market price for this bond will change. Okay. Example 1. A bank could have granted a loan at a higher interest rate than agreed. In this case, the resale value of the credit will change. Interest rate risk. In contrast to this situation, market interest rate changes in interest-bearing securities. These lead directly to price losses. Again, you have interest rate risk. So in most cases in which you have a fixed or a variable interest rate payment, you will face interest rate risk. This is why it's actually quite important. Interest rate risk management is such a large piece of risk management with a bank. Yeah. This is one interesting example. If you are interested in keeping the bond to maturity, the variable payments will change. But in case you are interested in reselling the bond before maturity, these variable changes will be offset because the market interest rates with which you discount the payments, they will also change. So in case you sell the bond, the floating rate note, before maturity, these changes in the variable payments will be offset by the changes in the market risk, market interest rate. Sorry. Okay. Next, credit risk. Credit risk, there are two dimensions to credit risk. The first notion of credit risk is that you lose all of your money. You have a full default of your debtor, of your customer, and you will not be able to recover any of your loss, any of your money. The second possibility is that you do not have a full blown out default, but the probability of default decreases. And you can see this many times when you look at the rating of a company. It might be that the rating of, say, Daimler or Mercedes, the same company, Daimler or BMW, that the company rating changes. This does not immediately mean that the company is bankrupt, you lose all of your money, but this simply means that the probability of default has increased or decreased. And this is credit risk, this is also credit risk. Okay. So every time you grant a loan, you will have credit risk exposure. And it's important to note that this is not just a problem for banks. Every time you have a future payment, you will have credit risk exposure. If the perfume store sells perfume, you pay via credit card, and suddenly you are not able to pay the money to your credit card company, in a sense, the perfume store has credit risk, and it has to depend on the credit card company to guarantee the payment. But every time you sell something and you do not get immediate payment for this service or for this product, you will have credit risk exposure. There are some peculiarities to each industry when it comes to credit risk. For example, I usually speak of the example in energy, in the energy and utilities industry. This is quite interesting. Actually, with energy companies and utilities companies, credit risk is a vastly important part of risk management. Why? When it comes to energy and electricity companies, why is credit risk so important to these companies? Yeah?
It's usually you receive the invoice after.
Yeah. You will use the electricity and you will pay your energy bill, your electricity bill, at the end of the year. And if you do not pay, what will happen? The company, after a certain after a certain period of time, will stop delivering electricity. But it is not able to recover the electricity that has already been delivered to the customer, and it will have a credit risk exposure. And this is why energy companies and electricity companies have large credit risk management departments. In their case, it's often quite simple to measure these risks. Why? A simple idea when it comes to retail customers in Germany. They always know what their maximum exposure per client is. They know approximately that a client in a single household uses, say, 40 euros for electricity per month, and they know that after 3 months the customer has not paid his or her electricity bill, they can stop delivering electricity. They can stop electricity. So they simply say, okay, our maximum credit exposure per client in the retail section is 40 euros times 3 months, 120 euros. After that, we stop delivering electricity, and we only start start delivering again if he pays up. So this is the maximum credit risk exposure for these companies. For loans, for banks, it's different. You might have a retail loan, you might have a large company that has $1 million loan, you might have different loans with different banks, and credit risk management with banking is more difficult. And I would say that I will continue this next week. Do you have any questions? Okay. Well, then thank you for your attention and see you next week.